Alright, hello everyone, and welcome to our last video for the midterm. We might create some more kind of things as I learn more, just going over concepts, but this is practice problem 2, project evaluation. So Parker Products manufactures a variety of household products, and the company is considering a new detergent. The company CFO has collected the following financial information about the product. So the project has an anticipated economic life of 4 years. So economic life of 4 years. So, all right. Then the company has already spent $100,000 on market research to determine the feasibility of the product. This is worthless information because it's already been spent. It's a sunk cost. We don't care. Now, the company will have to purchase a new machine to produce the detergent, and the machine has an upfront cost of $2 million. So, machine cost of $2 million. Let's see if that's enough zeros. Probably. Yep, it's perfect. Nice. Now, we'll expand this a little more. The machine will be depreciated on a straight line basis to 0 over 4 years. So depreciation will equal 200,000 divided by 4. So, or 2 million divided by 4. So the full price, because it's going to be going to 0 over 4 years, gives us depreciation of $500,000. And we're also going to just make both of these negative, just so it's easier going forward. Now the company anticipates that after 4 years, it will be able to sell this machine for $200,000. So sell price of machine. They believe they can sell it for $200,000. We'll make that $1 again. So that's all the machine information. Now to start the project, they will require $60,000 of additional inventory and $40,000 of additional accounts receivable. So we'll just do inventory of 60,000 and accounts receivable, we're going to just make that super short, of 40,000, and accounts payable of 20,000. Now, what does all this mean? Well, we're going to kind of come off here on the side, and what we're going to do is we're going to have the total net working capital, and all of these adjust net working capital. Now, they adjust it in different ways, but we're going to have years 0, 1, 2, 3, and 4 net working capital. Now, total net working capital to start the project is going to equal that $60,000, the $40,000, and then it's going to subtract the accounts payable. So how did we get this? Well, so how it is we need to have cash tied up in inventory of $60,000. And then we also need cash tied up in accounts receivable of $40,000. But we're going to have accounts payable of $20,000. And accounts payable is cash that we get to hold on to temporarily and don't actually have to pay. So that goes against net working capital and actually helps it out. So that's why it is 60,000 plus 40,000, which is 100,000, then minus the accounts payable of $20,000 gives us our total net working capital when we're starting. So then we'll get our change in net working capital. We're going to make this a little larger. It's just going to be 80,000 minus 0. Now, or equals 0 minus 80,000. Now, this is not truly, yeah, that's just the change in net working capital. And I need to spell change correctly. Change in net working capital. So very cool, very cool. But now the net working capital will decline by 1/4 of the original amount each year until it returns to its original level at the end of the project. So there's going to be no net working capital in year 4. So we'll just have that equal 0. But what we're going to do is we're going to see based on this that there's going to be a change. There's going to be a decline of 1/4 of the original amount. So what that means is we're going to have a decrease of 1/4 of this amount. So that's just $80,000 divided by 4. So we're going to have a change of $20,000 in net working capital every year for the next 4 years. So what that means is we're going to just have $80,000 minus the $20,000 being our total net working capital. And we're going to just copy that across. We can even copy it over to 0 or to year 4, and we get essentially that it'll start at $80,000 and then decrease by $20,000 per year until year 4. And that gives us our change in net working capital every year. And that's going to be useful later on as well. So that's our net working capital done. Now, the detergent is expected to generate sales revenue of $3 million per year for each of the 4 years. So sales, we're going to have $3 million. Boom, $3 million. And the variable operating costs are expected to equal 50% of sales revenue. So variable costs. And we're going to do that as a percentage, not 50 cents, but 50%. And they're going to have fixed operating costs of $500,000. Fixed costs, let's just say. Now, these fixed costs, I believe, are relative to the project. They're not just fixed operating costs of the entire project. But remember, if there was the fixed costs of the company are $500,000, but we are, using $100,000 of that, then that would not be that would not be like increased expenditure, and it should not be included. But in this case, it is, because I'm assuming that these fixed operating costs are for this project. So now, the new detergent is expected to reduce after-tax cash flows of the company's existing products by $300,000 a year. So cannibalization, and I might have spelled that wrong, but and I'm sorry if I did, but there we go. So $300,000 a year. And once again, we've kind of forgot, but we need to make all of these negative. So there we go. So fixed costs are negative $500,000. Cannibalization is negative $300,000. And we're gonna also say this is after tax, because that's super important. So after taxes. And now we have the required rate of return of 0.12, which is a percentage, and the tax rate of 30%. So we'll do that. All right, now we have all of the relevant information that we need, and let's get started. So first, we are going to create our years. So we'll have years, we'll have 0, 1, and we'll just use the shortcut to copy it all the way out to 4. And then we're going to have sales. Sales. So sales in year 0 are going to be none. We have no sales before the project even starts, but sales will be $3 million, and we're going to hit F4 to make them the same throughout. And so we're going to have sales of $3 million. What we're going to do here is we're just going to make it a little larger, one larger decimal place. That's kind of a little trick. If you want to expand all cells really quickly, just add a decimal place, and it'll expand them automatically for you. Super, super helpful. And then we're going to have cost of goods sold. Cost of goods sold. Now, this is technically variable cost, but we're just going to say cost of goods sold for the meantime. And it's going to be negative cost of goods sold, or cost of goods sold will be negative. So that's what we get. We're going to decrease that. And we're going to get then the gross profit equals the sum of these. So that's that. So it's just the sales minus the cost of goods sold, but we made cost of goods sold negative, so we can just use sum. So then After we have the gross profit, next we need to add in all of our fixed costs. So we have, first of all, just our regular fixed costs, right? So that equals $500,000. We're going to copy those across, decrease the decimal places. Then we're also going to have depreciation. So the depreciation expense will be also $500,000. So we'll copy that across as well. And I think those are all the fixed costs. Now you might be wondering why we aren't inputting cannibalization, but cannibalization does not go in this step because it's after taxes. So we'll add that in later. So this will give us our earnings before income tax, or interest and taxes, and we're going to just do the sum of all three of these, and there we go. We get 500,000 for each, and let's just double check that that's everything. Yep, looks like it is. Then we're going to do our taxes. So our taxes are just going to equal the earnings before income tax and then times the negative tax rate, because taxes are always the inverse of whatever your value is. I forgot to F for it, so F for your tax rate. There we go. And now we get that we're going to have taxes of 500,000. So this is going to be our net income. So equals the sum of earnings before income tax and tax. And there we go. Now what we're going to do next is we are going to add back depreciation. So add back depreciation. So we're going to equals the depreciation, but this is going to be negative depreciation because we're adding it back. F4, boom, pull it across, and we're going to decrease the amount of decimals. So after net income, we simply add back depreciation. After we have added back the depreciation, we also need to, because now it is after taxes, we also need to add in cannibalization. And cannibalization is equal to negative $300,000. And we're just going to copy that across. And now we should get our cash flows from operations. So equals the sum of net income, the depreciation added back, and cannibalization. So we get that our cash flow from operation is $550,000. Now, that's not it. We also have our capital expenditures. And I spelled that extremely wrong. Expenditures. Maybe that's right. I don't know. But we have a capital expenditure of $200,000 in year one. And then at the end, we also get to sell that capital equipment for $200,000 at the end. So we originally buy it for $2 million, and at the end we sell it for $200,000. Now there are taxes that we have to pay on this, so that's just the $200,000 times the negative tax rate once again. And so we have to pay a $60,000 tax on this sale. Now we're only taxed on the gain, but remember our depreciation, we've depreciated it all the way to zero, so the entire tax, or the entire cash flow is taxed. So we gain $200,000, but then we lose 30% of it, or $60,000 to taxes almost right away. And then the last thing that we have is our change in net working capital, and so those are just equal to what's up here. So in the first year we have $80,000 that we have to put into net working capital, and then all the rest of the years we have $20,000 that we're getting out of net working capital for the project. So this should be everything. We're just going to do the total cash flows, and we're going to do the sum of the cash flows from operations plus all these other things. We're going to make these dollar signs, get rid of the decimals, and we're going to just copy it all the way across. So there we have it, our total cash flows that we should get in each year. Now we just need to calculate the net present value. So it just equals NPV. We're going to take the rate, which is 20%, and we're going to grab our year 1 through 4, and then we're going to add in our total cash flow for year 0. And we get our net present value of negative $259,738.34. Very precise, but that is obviously a negative value, and we should not accept the project. We'll also calculate the internal rate of return, just like that. And we're going to Control X, Control V, move that over because we want it in this location. We're going to also expand this out, give it a few more decimals, and do IRR. So our NPV was about negative $260,000, and our IRR is like 6.12%. Let's double check that on here, and we're going to reject because the NPV is negative. That is correct, and our IRR is lower than our required rate of return. So that's how you do this problem. I know it was probably a little fast, but yeah, hopefully you learned something, and good luck on the midterm.